21,482 is where we are currently at. It's a fresh record high that we've seen. 6,415, that is the magical mark on the Nifty as well. That is, after hitting that, it's going to be the all-time high on the Nifty as well. So within kissing distance really of that mark too, we're not going to be left too behind.
Adrian Mowat joins us. Adrian, good afternoon to you. Thank you for joining us. Adrian, you've been bullish on emerging markets and your call on India is turning out to be right. But are you surprised with the velocity at which Indian markets have appreciated in last 10 days?
No, I'm not. I think positioning in emerging markets has been extremely bearish. And also the views on the Indian domestic economy have been very bearish. And I think India is moving into a very sweet spot where the export earners will still have a very good year in 2014 with a strengthening global economy and a very competitive currency. But the turnaround is going to be within the domestic economy. And we would view people's opinions on inflation and monetary policy to be too hawkish. And as we move towards the election, I think the hope is that you're going to see many of these projects that have been stalled start to get restarted again, and there'll be a build-up in confidence in the domestic economy. So you'll have both the domestic part of the stock market as well as the export part performing well. So, yes, we're at an all-time high on the Sensex, and I'm sure they'll be making many more all-time highs in 2014.
So, Adrian, clearly that's precisely the point which is playing out. What we're seeing right now is a hope rally in anticipation of the big overhang, which is the elections which are going to now take place come next month itself. What's the sense that you're getting about the FII inflows? Because slowly and surely we are seeing FIIs deploying more and more money. Is it ETF money coming into the markets, or do you think this is now long-only money which is starting to build up ahead of the big event, which is the elections?
If you look at open-ended fund redemptions, which is predominantly ETF redemptions, that's running at a level that would result in the same amount of redemptions, $42 billion, that we saw in the whole of 2008. So ETF passive money, retail money, is still exiting emerging markets quite aggressively. But the long-only institutional clients are finding the export sectors in India still attractive, even though they performed well last year, and is increasingly looking for opportunities in domestic cyclicals. So I look for the clues from the global institutional investors. The other thing I'd highlight is our local clients in India have been very pessimistic for a number of years now. I would say they've become less pessimistic. I don't think they've quite moved to the optimistic phase though.
You say, Adrian, that you are now recommending domestic cyclicals. What exactly are you talking about? Are you talking about autos or pure cyclicals like metals now?
Yeah, I think you're looking to be adding into domestic building materials, possibly engineering and construction, PSU banks, and the two-wheelers and the four-wheelers that have a larger percentage of revenue from the domestic economy and have been experiencing very, very tough macro environments for a number of years.
Do you think India otherwise is in a sweet spot because the macro governance is in place? There is mess happening in other emerging markets. On a relative basis, India suddenly is in a very favored space, so to speak?
Look, I'm out and out bullish on emerging markets as an asset class. I think India will outperform the broader EM index, partly because you'll get a lag in Brazil and China. I still think Brazil and China are going up. The positioning is very, very bearish in emerging markets. The level of pessimism is the highest I think I've really experienced since the Asian financial crisis. And I think that pessimism is excessive. Tapering has started. We're revising numbers on balance of payments from expecting balance of payments deficits to surpluses in a lot of EM. Loan growth deposit growth is beginning to pick up. Monetary conditions are easing. relative to expectations. And I think that's going to be a very powerful driver against this very pessimistic positioning.
I just want to get back to the point that you were making when you were chatting about cyclicals and your preferred list. You also talked about PSU banks. Does the toxic nature of the asset quality that banks have been reporting, and PSUs in particular, not worry you, or is it more a valuation game because they are available, so dirt cheap?
Well, equity markets are about what is the change in position. And so if the Indian economy, which has been extremely weak, which is obviously bad for asset quality, begins to accelerate, then fears on asset quality will diminish, and the risk premium in equities, whether they be PSU or private sector banks, will decline.
So what happens to IT in this kind of a scenario? Because if economy recovers, rupee will strengthen, and if rupee strengthens, there could be margin erosion for IT companies. Do you think IT could do well irrespective of the rupee or Indian economic recovery?
We're optimistic on an acceleration in U.S. growth, so that demand dynamic for the Indian IT companies is favorable. But I think positioning for a dedicated India fund probably means that they take money out of IT and rotate that into domestic cyclicals. So I think IT you make money in, but you might make more money in domestic cyclicals.
Also talked about a very hawkish central bank, and which is something that we've dealt with, though in a surprise move earlier, this year. Does it seem like now, with the recent current account deficit numbers, which have really surprised the street and pleasantly so, we could see the RBI now change its stance, and soon enough we could be staring at an easing regime when it comes to interest rates?
Well, I think the first stage is to go from an expectation of higher rates and a persistent high inflation to one that, you get a couple more positive surprises on the CPI number, and maybe the market expectation moves from an additional couple of repo rate increases to none at all. And then if inflation does come off as we enter into 2015, then you might start to thinking about pricing in an easing cycle. But remember, the expectation we're starting from and the guidance is a relatively hawkish central bank. But I think that's what's priced into markets.
Right. Adrian, final question. What is your real take on consumers? If you're making a case that Indian economy will come back, I mean, if economy comes back, that's great news for consumers, and that's great news for FMCG stocks as well.
No, I don't think it's good news at all for FMCG stocks on a style basis. These stocks globally have been bid up in the last couple of years when EM growth has disappointed, and there's also been a lot of M&A activity. I think FMCG is overvalued, and we currently recommend a zero weighting in consumer staples throughout EM. We had a conversation a little bit earlier about what to do in the auto space. So your consumer discretionary in terms of market cap tends to be autos in EM, and that's also true in India. I think the problem in buying retail is that we're seeing a rapid adoption of e-commerce in emerging markets, and retail stocks tend to be quite asset intensive, and I don't think that's the right place to be.